Okay, so very good morning. Welcome to the briefing then for Friday the 29th of July. So some big news overnight. Bank of Japan, or the notorious BOJ as they're now known. But bigger news than that, Bill Norman, got to give the big man a shout out. It's Bill Norman's last day here at Amplify Trading. I know that a lot of you who listen have been mentored by Bill for some time. He's been with us now a couple of years. He's helped many traders through the programs with his excellent macro knowledge and his own personal account that he trades, and then trying to kind of teach that onto others. So big thank you to Bill for all his hard work. I'm sure you guys will join me in saying that. Live guys, I know Lauren, Rabia, Adil, so on, you've worked closely with Bill. So again, thank you very much for all your hard work. So cracking on, let's have a look at the Bank of Japan now. That was the big thing from overnight. And I've got two charts here on the top left and top right. So that's the Nikkei 225, the domestic stock market in Japan, and also the Japanese yen. Now, there are two things here that are particularly interesting. For one, on the top left is the Nikkei. So when the announcement originally came out, the Nikkei spiked lower, but ultimately at the end of the Asian session we actually finished up around 0.6% in the Nikkei 225. The Japanese yen, however, is aggressively stronger than it was than pre-announcement levels. We were trading up at around the 105 type levels. We breached 103 briefly to the downside. So what exactly have the Bank of Japan done? Well, I think HSBC had quite a nice summary line on the matter. They said that the Bank of Japan today offered markets a little appetizer, but the full menu of easing has been kept in the oven for another day. So ETF purchases have been expanded to 6 trillion yen. That's almost double the original target. So that is the action that they took on a kind of stimulus action front. But the minus 0.1% base rate, the actual interest rate, remember, market was pricing in around an 80% probability that the Bank of Japan were to cut rates, and they haven't. That did not occur. They kept rates at negative 0.1, and they maintained the pace of QE purchases held at 80 trillion yen. So again, no expansion on that front either. So they've tweaked just one part, where the market was largely looking for the full Monty, so to speak, from the BOJ, or at least that's what's been communicated through various source comments earlier this week. Hence then, the underwhelming action has weighed on the Japanese yen, and we've moved, as I said, from around 105 down to 103. Now we've started to climb a little bit here in more recent trade. However, I think this is more to do with the fact that the Japanese stimulus package has taken some precedence. So although the Bank of Japan is underwhelmed, the Japanese government has stepped it up considerably. So Shinzo Abe promised economic stimulus package will include 13.5 trillion yen. That equates to around 130 billion US dollars in fiscal measures. So both direct government spending and loans. So in essence, you're getting, let's say, the help from the government rather than the BOJ directly. It's almost as if they're kind of holding back, saving a bit of ammunition, which could be a wise move. But ultimately, it'd be interesting to see where the yen goes from here. Looking at dollar yen on a slightly longer time frame, it's tough to see this dollar yen not getting back down towards the 100 level again. This big spike lower here, that was the Brexit, June 23rd, 24th, that overnight session where the risk-averse tone with the big sell-off in sterling prompted yen flight to quality. We spiked lower, we recovered, found some support. That 100 level psychologically and technically is very important. And here we are back at 103 after going up to close to 107.50 at the initial highs in mid to late July. I would say that keep an eye on bank commentary to see what other analysts are thinking, but it's hard to see, given the lack of action taken from the BOJ. the history would tell us that the market tends to be very underwhelmed by that particular central bank, and a retest of 100 in the coming weeks, I think, cannot be discounted at this point. The Nikkei, on the other hand, is a slightly more trickier one to look at. Now, we moved up ahead of the announcement, we spiked lower on the disappointment, and then we rallied up 0.6%. I'm not going to sit here and try to explain the ebbs and flows of every single move here, because that's really not possible. The one thing is, though, it seems, as at least on the intraday, that the fiscal stimulus side has been enough to appease the equity community. But obviously, movement in the Japanese yen, vitally important for their domestic stock market, given the high proportion of export names within that index. The Bund future, you can see huge gap lower here at the open. Well, if the Bank of Japan are going to disappoint market expectations of easing, what does that mean for the yield? So 10-year Japanese government bond yields, biggest moves in the past 5 years. The move that was seen overnight is the third biggest move that we've seen in JGB yields to the upside in the last 5 years. So 9.2 basis points it rose. So therefore JGB's seeing a significant move lower overnight. That meant that the Bund future open just playing catch up with that move in sympathy. However, the situation in Europe hasn't effectively changed, so hence I think we've kind of pulled back already, moving back above that initial S1. It wouldn't be surprising, I think, at some point to come back up to pivot, to recover and look to close some of that gap. Again, a bulk of that move, treasuries already. We were down in the 10-year around 132.03.5. We're already back to 32.16. So again, the move is just purely in sympathy with the fall in JGBs, but now it's kind of back to the current markets that we're looking at. So that's your kind of BOJ story. The other thing to look at this morning is there's been a lot of corporate earnings actually. Quite unusual for a Friday, but this is kind of peak time European earnings season. Just taking a look at a couple of names of note. For Barclays, their shares have bounced 4%, top of the FTSE, after its profits fell a third in the 3 months to June. But like we're all becoming accustomed to, even though the profits fell a third, they were bad, but not as bad as expected, and hence their shares up 4%. Foxtons, they're down quite sharply this morning though. They've reported a 42% first half profit plunge as the Brexit vote weighed on the already weakening London property market. So these are all more like FTSE based names. Another couple of big names reported after market though. On the tech space, Google, parent Alphabet beat analysts' sales and earnings estimates thanks to the company's ad business. And Amazon projected revenue for the third quarter that may beat analyst estimates. They're boosted by record sales of Fire TV sticks and Echo devices. Their cloud systems as well. Revenues are increasing, so Amazon shot higher after market as well. There's a lot of other big names that are reported. UBS, their profits slipped in the second quarter. They've actually they've abandoned their near-term profitability target. That is concerning. Their shares are actually a little bit weaker this morning. Sanofi, one of the biggest pharmaceutical companies in the world, the French drug maker, their second quarter profits fell 8.7%. Competition from cheaper rivals eroding their sales. So this type of period of earnings season, you do definitely have to keep an eye ahead of the cash equity open for sure, if you're to effectively trade the futures of what some of these single stocks have been like. But a bit of a mixed bag, I'd say, this morning. Now, sticking with the equity theme, one of the big things that we're looking for today is the European stress tests, but they are coming out at 9 p.m. this evening. I mean, call that planning, if you like. Let's avert the main part of the trading day. Let's wait till everyone goes home, and then we'll start releasing the stress test results. It makes perfect sense from a point of view of looking to cause, let's say, as little impact on the market as possible. We went over this yesterday, but just a quick recap. Quite importantly, there is no pass or fail with these stress tests, which has occurred with previous stress tests. Either there'll be a number, let's say 5, 7 or 10 banks of the 51 have failed. That's not going to happen this evening. What is going to happen is a host of information with the ultimate test outcomes feeding into supervisors' review and evaluation processes then to manage their capital and any capital requirements they may have going forward to make their balance sheet or company more robust. So you're not going to get this pass-fail mark. It's going to be, some banks are going to have a situation where they're going to have to raise capital by the performance of their core tier 1 ratios. So 51 banks are in this test with a minimum of 30 billion euros in assets, and representing about 70% of total EU bank assets will be covered. This does include 5 Italian banks. They're going to be the ones to watch. We've seen the Italian government at pains to try and soothe investor confidence by injecting 5 billion euros of capital into Monte Paschi, the weakest of the bunch, expecting pressure in those results. But as we've always said, market moves on expectation, and expectation is the Italian banks will come out the worst, and the German ones likely will also be under significant pressure. So that should not come as too much of a surprise to the market. One of the criticisms, though, before the results have even been released, and I did read about this yesterday, which I find quite amazing, is that one of the key stresses is what would happen under rising yield scenarios. But we know what the situation is. Yields are not rising, they're falling, and they're falling sharply, more and more into negative territory. But these stress tests don't actually run a scenario for prolonged negative rates. So how credible can these stress tests really be when the methodology that they're using isn't actually up to date? So I've got a bit of a question mark here about how much the market will move over these, given that factor, and given the fact that a lot of the weakness in Italian banks and German banks has already been baked into expectations. Also, one might ask how much investors rely on it since the last stress test in October 2014, where 99 out of 123 passed. The Euro Bank Equity Index is down 38%. So basically you're saying that most of the banks, the majority passed, and yet the bank index is down 40% since that last stress test. So how much of a good indicator or an insight really is it? Is a bit questionable. Okay, quick look at the calendars for today. Let me just bring it up into shot. So we do have, we've had a couple of figures already. Let me just recap them for you. Pretty early on at the Eurex Open, we had the German retail sales at 7 a.m. this morning. Month on month was in line, minus 0.1%. The year on year slightly higher than expected. We've had French CPI data year on year, same as previous at 0.2%. Spanish GDP, 3.2% Q2 preliminary number, 0.1 higher than expected. So none of this really market moving, all coming in pretty much in line with expectations. As the morning continues, though, keep an eye on the Eurozone CPI number for July. That looks like a typo for sure here. I'm sure that's expected to be at 1 or 0.1%, same as previous. But obviously, inflation, a key area. The reasoning why, or one of the reasons why the ECB wants to expand their QE program to try and stoke inflation, get it back in towards target off these very depressed levels. So keep an eye on that figure. Inflation readings, as with the Fed from that Fed statement, is going to be very important for a lot of these central banks going forward. This afternoon, though, is when it gets a bit more interesting from a data perspective. We've got the first reading of second quarter growth for US GDP. Looking for a decent bounce here. Median consensus on the street is for 2.6 from 1.1%, so a significant improvement in the second quarter. We've also got the likes of the core PCE, Chicago PMI, and also University of Michigan. Speakers, Fed's Williams, Fed's Kaplan also to come. So Quite a busy schedule actually, more weighted towards the US trading session. Okay, so that's your morning briefing. Gonna wrap up with that. Enjoy your trading day. Thanks very much.